Okay, the initial underwriting phase of a loan. So basically, once you've received all your application and your initial disclosures, you've looked over everything looks good, loan officer, if you haven't done a pre-approval letter like we talked about earlier, and that would be a TBD property is what we call it, a to be determined property. And it just means that we've already put it into underwriting. But if we didn't do that, then now it's gonna go into underwriting. And an underwriter, what are they doing? Well, they are looking over all the details in the loan application. They're looking over all the documentation you provided. They're looking over all of the initial disclosures that we provided to you. So basically the job of an underwriter is to make sure that you qualify based on the guidelines that are set forth by the different investors that are either purchasing these loans. And I'm gonna get into that for just a second. So there's Fannie Mae, there's Freddie Mac, and there's Ginnie Mae. They are all quasi-governmental agencies, to be honest, that buy all of the loans that are within certain loan amounts in the United States. And it's the vast majority of loans are all bought by those three different companies. And basically with that, they have guidelines that they've put forward as far as how to be able to qualify someone for a loan. And so the underwriter is really looking at those guidelines, making sure that you qualify based upon the loan program that you have selected and that type of thing. And basically they're gonna ask questions. So let's say you have deposits coming into your bank account that are rather large. Well, they're gonna ask you, why do you have this deposit coming in? Where'd you get that money from? They're gonna ask you about your employment. They're gonna ask you to do a verification of employment. That's typically done through your employer or a third-party company. There's a lot of different companies out there that go through a third party, so they don't have their own employees having to send out these letters to lenders like ourselves. So basically it's just gonna say you're still employed, this is how much you're making, that type of thing. But there's also things like letters of explanation. So if they have, let's say you've had your credit pulled multiple times, they're gonna say, well, why did you have your credit pulled? Are you trying to get another loan? Or is it just that you were maybe looking at other lenders and two people pulled your credit to see if you could get the best deal out there on this mortgage loan? Well, that's what they're trying to determine. So that's all underwriting is. And then they're gonna issue a conditional approval. And the conditional approval is just saying, hey, at this point you are approved. Now there may be still things pending, and we're gonna get into that next on the video, which could be like an appraisal, it could be other things. So conditional approval, what does that mean? Well, basically what it means is the underwriter took a look at your file. They said, hey, with all the information that you provided, the documentation that you provided, all this, you are approved at this certain loan amount. And this property is also approved at this certain loan amount for you. And so with that, they could be waiting for an appraisal still though. And so that's why it's conditional, because it's not finalized. We don't know for sure it's gonna close yet, but it's looking pretty good.